Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Why final salary pension values have soared during lockdown and what to do about it. The average transfer value of final salary pension schemes rose to £556,000 in the second quarter of 2020. That's according to an analysis by the pension consultants Lane, Clark and Peacock. This increase in transfer values represents a 30% rise on the previous quarter's average transfer value. And it's the first time in 3 years that the average transfer value has exceeded £500,000 again. So although the average transfer values increased substantially, the overall level of transfer activity has fallen by 25%. There could be a number of reasons for this, not least of which the delay in obtaining transfer quotations during lockdown because of people working from home and perhaps being short of staff for furloughing with these pension consultants. Interestingly, people with smaller pensions were the ones who were least likely to transfer them, mainly due to the stock market crash in February to March this year. But people with larger pension pots, generally speaking, likely to be better financially educated and maybe a bit more savvy, shall we say, they understood that it was a great opportunity to transfer pensions at that time, because if you were to have done so, say, before the beginning of April, you would have benefited from an amazing rally in share prices since then. So you'd have had the double benefit of an increased transfer value, substantially increased transfer value, and a huge rally in share prices. Now, the reduction in base rates from 0.75% to 0.1% was a major reason for the increase in transfer values, because it led to yields on government stocks falling to a record low level. The reason this is important is because when the yield on government stocks falls, the transfer value of final salary pension schemes increases. So in other words, it has a seesaw effect. Why is this? Well, it's because the yield on government stocks is a factor that's used to calculate the very same pension transfer values for final salary pension schemes. Therefore, the lower the yield, the better. Now, according to the same company, Lane, Clark and Peacock, the current level of transfer value quotes is back up to about 3/4 of pre-lockdown levels. But there's a number of new changes to the rules on final salary pensions being introduced by the FCA from 1st of October, which I feel is likely to lead to a reduction in transfer activity and less advisors being willing to give advice on the subject, because there's going to be a ban on something known as contingent charging. What this means is that if you take advice on a final salary pension, you will receive usually a very comprehensive review report that can run to literally 30, 40, 50, 60 pages or more, with many calculations. And this is because of the FCA's stringent requirements on such business. And in the past, what's happened is you may have to pay a certain minimum fee, but in practice, most firms wouldn't charge the fee unless you actually transferred. So that's known as contingent charging, which of course is the way most pensions or investments are advised on. Or in fact, most business transactions you don't really pay unless you proceed. If you receive a proposal, one business to another, you don't pay for that proposal. You decide whether or not to take up the proposal. That's contingent charging, which is the way that most of the business world goes around. But for some reason, the FCA has got a bee in its bonnet about final salary pensions. It has this blanket rule that if you transfer out of the final salary pension scheme into a personal pension, it's deemed to be bad advice unless you can prove otherwise. Quite frankly, I find it ridiculous, because in my experience, every case should be judged on its merits. There's no one rule for all. It never is that way in life, let alone in final salary pensions. nonetheless, that's the way it is. So what it will mean is from 1st of October, if you want to get advice on your final salary pension, there'll be 2 stages to it. The first stage, which will be low cost and possibly free of charge, is something known as abridged advice, where the advisor will make a decision whether it should be transferred or not. If the decision is no, then you don't go any further and you pay the modest fee or 0 fee, or the case may be unclear, or there may be some missing information, in which case you have the opportunity to progress to the next stage, which will be something you have to pay for. The report, the comprehensive report, would have to be paid for, whether you decide to transfer or not. This is a ban on contingent charging, which is why I think the amount of activity in final salary pension transfers is likely to go down. Because if you've got a large pension, let's say it's £500,000, and you're faced with a fee of 10 grand, you've got to pay whether you transfer it or not. I think it's going to put some people off, or many people off really, even though the result may be hugely in your favour. So at least you got the benefit of getting the abridged advice first, where you have an indication whether it's worth transferring or not. So that's the way it is. Now, there's still an opportunity for these smart final salary pension scheme members who recognise that, again, there's another chance to benefit from high transfer values and a soaring stock market, because the stock market still seems to be rising. Trouble is, it's a double-edged sword. Transfer values could rise even more, believe it or not, even though base rates are down to 0.1%. There has been talk that the government may even go into negative interest rates. And amazingly, that would increase transfer values even more. Now, the downside is that if you were to transfer and get an even more enhanced transfer value, and then plunge all of your money into the stock market, then any benefit could be wiped out by a large stock market fall, especially because the US stock market is vastly overvalued on any metric you choose. Historically, it's the most overvalued it's ever been. And of course, if the US stock market falls, so will the rest of the world's stock markets, although I don't think by anywhere near as much, because there's an old saying that when the US sneezes, the rest of the world catches a cold, and I think that's very true. Of course, what you would do is, if you were to benefit from a high transfer value, an even higher transfer value if base rates fall even further, you don't have to invest your money 100% into shares. I mean, you could even invest it in cash and just wait until markets decline and then recover, for example, or drip feed into the stock market, or just simply spread your investments across a range of asset classes, typically bonds, cash, shares and property. So, I don't really think that's a reason for not considering having your final salary pension reviewed and possibly transferring it. The choice is always yours, of course, but if you've got a large final salary pension scheme and you meet a number of criteria, which I'm going to list now, then it's highly likely that it's worth at least having your final salary pension scheme reviewed, and as a minimum to get abridged advice, because there are companies that are offering abridged advice for free. So what have you got to lose by getting abridged advice and an up-to-date transfer value? So let me give you some of the type of characteristics you would typically have, the type of character you would have to consider getting your final salary pension scheme reviewed. There's quite a long list of 15 criteria, but let me just run through it and see what you think. So the first one is you should have a medium to high attitude to investment risk. Number 2, you accept that prices rise and fall and you may not get back all of the money you have invested. 3, an understanding that higher risk means potentially greater reward, as well as a greater risk of loss. 4, you already have sufficient wealth and guaranteed retirement income to cover your cost of living, which means you're not reliant on your final salary pension. In other words, you can afford to lose it, not that in practice you would. 5, a large transfer value. Now, what I mean by that is more than £500,000, and that the value is assumed to be, as a minimum, 25 times your accrued pension to date, and ideally 30 times or more. Now, what do I mean by accrued pension? Well, when you get a final salary CETV or cash equivalent transfer value, Most companies will show you the pension you earned up to the date you left the company, or it will give you the pension at retirement. It rarely gives you the pension you've accrued to date because, of course, when you leave a final salary pension scheme, it still continues to rise in value by some form of indexation. So the key is to know what pension you've earned to date. In other words, if you took the pension today, and when I say today, you have to be over age 55 to draw a pension currently. And that will give you the way of calculating whether it's an attractive transfer value or not. So, as I say, if your pension is, let's give you an example. Let's say your pension was £10,000 a year, and you were offered a transfer value of £300,000, accrued pension to date, £10,000 if you took it today, then that's 30 times. £300,000 divided by £10,000. That's an attractive transfer value. So it certainly would be worth at least considering getting it reviewed to a bridged advice level. Number 6, if you're married with children and even grandchildren. 7, reduced life expectancy, a terminal illness. Interestingly, this is one area in which the FCA does approve final salary pension transfers, because virtually on every case imaginable, you're better off, your family's better off if you transfer from a final salary pension scheme into a personal pension and you've got very little time left to live, because the death benefits are usually substantially greater. Number 8, a desire to retire early, ideally 5 to 10 years before the normal retirement age of the scheme. And the final salary pension scheme has a high penalty for early retirement. This is known as an actuarial reduction, and typically companies will apply penalty of 6% reduction in your pension benefits for every year of early retirement. So if you take your pension 10 years early, let's say 55 instead of 65, you're looking at a typical reduction in your pension of 60%. Now that's quite a huge penalty. Now, such penalties do not apply on a personal pension. It will be the same transfer value you would get whether you take the benefit straight away or not. So, number 9, a wish for pensions flexibility for both income and tax-free cash. We've had many cases where a client doesn't want to take an income. They want to take a lump sum out of their pension for whatever reason and take their income later. Well, you can't do that with a final salary pension scheme. Number 10, a distrust in your pension scheme's ability to pay the full pension you're forecast to receive, especially if your pension scheme has a large deficit and could be taken over by the Pension Protection Fund, or may have already been taken over by the Pension Protection Fund. This is a really important point. We've had cases with deficits of the pension scheme of as much as 52%. And when I talk about a deficit, we're not talking about it just being technically a little bit underfunded. I mean, a deficit is really a euphemism for insolvency. If a company has got a pension scheme with a 52% deficit, it means it's got 52% lack of money to pay the pensions it's promised. I mean, that's no joke. Now, in cases I've come across, they're not normally as bad as that, but certainly it's not uncommon to come across a pension scheme with deficits of 10, 15, 20% or more. And unfortunately, these deficits combined in final salary pension schemes rise year after year after year inexorably, despite companies' promises to pay off and a plan to pay off the deficits. Number 11, you do not want your pension to die with you and your spouse if you have one. A final salary pension scheme on your death, if you're not married, or on the death of your wife or husband later, if you're the first person to die, the pension dies with you. The exceptional circumstance, you've got young children, usually below age 23, you might receive a small pension, for example. That's not to be sniffed at. We've come across cases where people have final salary pension schemes that are worth £1 million or more, and they're not aware of this, that if it was in a personal pension, that money the whole pot would be passed down the generations to their spouse, then down the generations, free of inheritance tax forever. And the pension amount does not get added to your other pensions for calculating something known as the lifetime allowance, which is something which can create an excess tax charge on your pension if you're fortunate enough to have more than 1,073,100 in it. Number 12, you accept that in theory, at least, you could potentially deplete all of the cash from your pension after it has been transferred. Well, whilst that's theoretically possible, I've never yet, in a career lasting 34 years, had a client whose pension has run out of money. Most people are sensible, most people are cautious with the pension money, and nobody wants it to run out. So you basically work with an advisor who uses lifetime cash flow planning, who demonstrates to you and updates the cash flow forecast every year to ensure you don't run out of money. 13, you wish to extract your pension benefits in the most tax efficient manner possible. You can do that with a personal pension in income drawdown. You can't do it with a final salary pension scheme. With a final salary pension scheme, you have to take the tax-free lump sum at the date you draw the benefits, and you have to take a pension. Whether you're a higher rate taxpayer or not, you have to keep taking the pension and being clobbered for tax when you don't even need the income. Is that what you want? Number 14, you want control of your own pension rather than leaving it with your ex-employer to manage. And we come across many clients who simply don't trust their previous employer and they don't want them to manage their own money. Number 15, you feel very strongly that it is your money and you have the absolute human right to manage it yourself as you see fit. I think that's perfectly fair and reasonable. After all, you are an adult and it is your money. And it seems to me that the regulators, the FCA, seems to have forgotten all that. And they want to put you into this nanny statism way of just doing what they think is right for you rather than what you think is right for you. Now, this list is not an exhaustive one, but it does indicate the factors that are most likely to lead to you deciding to get your final salary pension scheme reviewed. So if you fulfil many of the criteria I've just listed, those 15 criteria, particularly if you were to fulfil, let's say, 10 out of 15, then why not ask for a review from a qualified pensions expert such as us? You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.